Good evening, everyone, and welcome to today's webinar on global investment outlook and key emerging investment themes. The year has begun on a challenging note. With the turmoil emerging in the banking sector in the US and European regions, we saw the narrative changing. The event also made us rethink how interconnected the world economies are, whilst we still keep hearing about decoupling more often than not. The more we understand the global milieu, the better we can extrapolate the role of domestic story. With this line of thought, we would like to invite today's expert speaker, Mr. James Cheo. He's the CIO Southeast Asia for Global Private Banking and Wealth, HSBC. He provides thought leadership on investment strategy for private banking and wealth clients and has almost 2 decades of experience in investments and has worked with marquee organizations in the region. I would like to warmly invite James to share his perspective, post which we shall open the floor for question and answer. Over to you, James.
Well, thank you, Nihi, and thank you, everyone, for dialing in and watching this webinar. I think financial markets have been extremely kind of exciting over the last year. And of course, the first 3 months this year has been nothing short, but really many shifts and turns in the whole economic plot. Of course, in January, what we have was that there was a great optimism of China's reopening. Markets went higher. February really happened when there were concerns that inflation is going to be an issue and that central banks had to increase interest rates even more. And when March came, what we had was a kind of banking turmoil that sort of created so much fears. And the question is, as we are now into April and going into the rest of the year, how would these shifts and turns in markets mean for investments? And of course, how do you capitalize on the opportunities? I think very importantly, I want to show some broad trends. But I think before we go into that, we have to take stock of what happened with the banking kind of turmoil. And I think we are a month past that since the peak of the crisis. What's clear is that we have seen the stress subside significantly, and that's the good news. During the peak of the crisis, there was huge amounts of deposit flows, especially deposit out, especially for the US small and regional domestic banks. So there was quite a bit of deposit outflows there. And a lot of the outflows actually went into money market funds. But I think that trend has sort of stabilized. So the outflows from small banks have sort of tapered off. At the same time, flows into money market funds have also started to stabilize. So I think there is some signs that things are starting to improve. And of course, at the heart of it, it's really an issue in which there was a fairly lenient regulation for many of these smaller domestic banks, especially in the US. And that's why you have had banks such as SVB having poor business models. And as a result, as with all bank runs and loss of confidence, some of these banks have needed government support. And also, of course, one of the key players in this whole crisis is the Federal Reserve, which came in to provide kind of liquidity support for many of the banks. So what they did is to use the discount window and also a facility called the Bank Term Funding Program, in which banks can go to the Fed, take their collateral, place that collateral with Fed, and get liquidity in return. So this facility is actually important to kind of backstop any bank run. So all banks actually could kind of take their illiquid assets and place it with the Federal Reserve and get kind of liquidity instantly. And that allows them to stem that whole deposit outflow. And I think that facility is very, very crucial. So at the peak of the crisis, about 2 or 3 weeks ago, we did see the Fed's discount window rising to above 160 billion. But since then, we are seeing some stabilization in terms of the banks needing to go into the Federal Reserve for that facility. So a lot of this facility is starting to wind down, which is actually good news. So we are seeing improvements, especially when it comes to the funding situation. And of course, in terms of the price money, the money markets continue to function very smoothly, even throughout the entire debacle. And I think since then, we are seeing quite a lot of normalcy returning back to the markets. But having said that, I think that the US regional banks continue, in terms of equity price, continue to be depressed. We are clearly I think the situation is very much how I would characterize as a sort of a cardiac arrest on the economy. And of course, the banking system is the heart of the economy. So the banking system went through a cardiac arrest. The Federal Reserve and various policymakers came in to resuscitate the economy and banking system. And I think since then, the economy has, the banking system has kind of recovered because of the very preemptive intervention. But nevertheless, the banking system is still, in some ways, recovery is still very much fragile. And we need to monitor how the transmission mechanism of how how lending flows would be and the impact on the real economy will be in the weeks and months ahead. So I think that's something to watch out for. But also, despite this whole recent turmoil in the banking system, when you look at the economic indicators, it's actually surprisingly resilient and healthy. Because going into this banking crisis, the delinquency ratio or the non-performing loans, whether it's residential loans, credit cards, commercial, and industrial loans in the US banking system has been very, very low. So it did not lead to a sort of a spike in non-performing loans as yet, but we are monitoring this indicator very clearly, because one of the implications, of course, is that because of this whole crisis, what you will get is a situation in which banks will start to think twice about lending and increasing their increasing their risk appetite in terms of lending out funds, really because they are in the mode to sort of conserve and be more judicious with the capital and with the deposits that they have. So I think that's something to watch out for. And clearly, I think the role of central banks and also the FDIC in guaranteeing the deposits of those banks that had trouble, I think were very, very crucial in preventing and resuscitating the banking system. But also, I think what's also very important, the situation, since, I've talked about the US, but now maybe I'll speak a bit about Europe, because there are similarities, but there are also very much differences. The similarities would be, of course, it is also a background. But I think in Europe's case, the situation is more specific to one or two institutions, particularly institutions with poor profitability. That's also another similarity with US, whereby you have a few institutions that were not managed well. So similarly in Europe, is that the case? But I think in Europe's case, the difference will be, I think, where the problem came about was not so much in the failure of Credit Suisse, but it's really on the ambiguity associated with the rescue package. Because after the global financial crisis, it gave birth to contingent CoCos as part of the capital structure to kind of buffer the banks in case. Because it really is to protect the depositors since the global financial crisis. And of course, that led to the development of CoCos. And CoCos up of the AT1 capital structure in which common equity usually is the most is the first one to take the hit. Of course, next would be AT1s, and then it goes to others in the capital stack, whether it's senior debt, etc. So I think the issue with Credit Suisse is really the rescue was that the regulator allowed the equity holders to take lesser hit, while the AT1 debt holders got a complete wipeout. And of course, they with all holdcos, there's always the regulator always have a discretion to activate. They call it the point of non-viability, in which the regulator makes that call. Other than one of the crucial factor is really if the capital goes below the regulatory capital, that also would wipe out the AT1s. But before that, the regulator does also have an option to make that call in that clause of non-viability, in which they are able to say that the bank is non-viable. And I think clearly over that weekend, fateful weekend, I think regulators were able to see that the deposit outflows for Credit Suisse was so big or so large that when it opens on Monday, it won't be a viable organization. And I think those deposit data is something that most market participants have no privy to, and they made the call. But it's not so much on them making that call per se, because back in 2017, Bank Popular, also a bank in Spain, failed likewise. But the European authorities at the time activated the same non-viability clause, although there was not a breach in capital ratios. The European regulators wiped out AT1s, made the decision to let the AT1 debt holders take the hit. The difference this time around with the Swiss regulator is that they not respect the capital stack. I think that's the issue. They allowed the equity holders to go scot-free, unlike during the Bank Popular situation, in which the equity holders took the hit and thereafter the AT1 holders. So I think that's the difference, and that's what scared many market participants, especially those that hold on to AT1 debt. But I think since then, a month on, I think we have seen the AT1s market recovered quite a fair bit. There is a lot of differentiation when it comes to which bank can do well and which banks are weak. And I think that confidence also comes from many of the regulators, particularly in Europe, in parts of Asia, assuring that investors that they will respect the rules of the capital stack and in terms of the priority when it comes to AT1 debt holders. So I think that's the situation in Europe, in which it was that whole debacle was not just about an institution's poor running of the company, but also because of the regulator making an ambiguous decision. But I think since then, quite a bit of all these volatility has subsided, and I think that's the good news. But I think importantly, to take a step back, we have to see that generally as a system, banks' capital, whether it's in Europe or in US, actually very, very strong as a system. And I think the authorities stepping in to show our confidence and providing liquidity to the system is actually very, very important. One of the chart, the central bank's balance sheet, remember, is the line chart on my right. Remember that many of the central banks are actually tapering or going through a quantitative tightening because of the crisis and because of what I've explained earlier on with the discount window. In fact, their balance sheet actually went up back again, really to support the banking system. So I think that's going to be a feature, which is a very crucial feature. And also it places central bank at a very almost at a balancing act right now. Because remember, back in last year and this year, they have to fight against inflation. So that was their key objective, price stability. Now they have to manage financial stability at the same time. So they are trying to balance it. They are doing a balancing act, and they are trying to manage both risks, and they have to assess which risk is going to be bigger. And of course, one of the reasons why we have all this debacle is also because there is leverage in the system. And there is also, of course, very high interest rates at this point of time. And that these are the kind of the macro backdrop that sort of triggered all these banking turmoil. But I think another important implication is that because of this whole situation, as I've mentioned, it's really a time in which the banking system went through a cardiac arrest. Central banks came in to resuscitate the banks. But going forward, banks will be a bit more judicious to lend out capital, and we know that that will mean a slower growth going forward because of tightening of financial conditions. So the good news, I would say, coming out from this whole debacle is that we are nearer to the peaking of interest rates than before, really because of that slower growth prospect. And also as a result of lesser credit going into the financial system, it also means that inflation could actually fall much faster than most people think. So I think this is probably kind of the good news or the silver lining that has emerged from this situation. But as much as there are twists and turns since January, February, March, and I think April, we are seeing a little bit of normalcy. I think one of the features to me is that going forward, what should investors watch out for? I think very crucially, there will be many of this sort of risks out there, whether it's geopolitics, whether it's the US debt ceiling that's in the middle of the year. These could create a volatility. So volatility is definitely something that, or uncertainty is definitely here to stay for 2023. But one important feature or the trend that you have to observe is really, and importantly, is the peaking of interest rates. I think that is a trend. Interest rates are going to peak. And in some countries in Asia, particularly in India, interest rates to us has already peaked. So I think from that perspective, this is a very strong trend. It has implications for investing as well. So the peaking of interest rates is one very crucial implication. And of course, that also means that inflation has already peaked and likely fall from here going forward. So the peaking of interest rates is the key trend. Another very important trend is that I don't think we're going to get a global recession. It's going as a result of this whole banking crisis. Why is that so? Because, number one is that Asia or even India, China is still growing very strong. China easily can grow 5.6%. India, likewise, easily more than 5-6% range sort of growth. In order to create a big global recession, I think the economic shock has to be very, very large. But if the central banks were not proactive a month ago and did not intervene, I think we could have had a global recession. But because of the central bank's intervention in such a swift and decisive manner, we sort of averted a global recession. So I think a global recession is unlikely, but there will be divergence in performance because a lot of the problems are happening in the US, in Europe. It's very likely that Asia will outperform the developed markets. And clearly, I think the developed markets, US, Europe's banking system is still a little bit fragile. It's recovering. It's still a little bit weak. So I think from that perspective, it's clearer that Asia is going to do much better for the rest of 2023, given that Asia's banking system was hardly affected, and given that inflation in many parts of Asia is actually falling. And very importantly, and of course, inflation in Asia is lesser than that of the other markets. And so very importantly, another feature is that Asia's interest rates vis-a-vis inflation is actually now, in terms of real terms, is actually positive, unlike in the West, where it's still negative real rates. So that means that it's likely that it puts the central banks in Asia in a much stronger position, because it also means that monetary policy is able to bite the economy. And they could, even if the economy does, or if inflation does fall back to their target, they could actually even cut interest rates. So I think the important takeaway to me is that Asia is going to outperform developed markets for 2023. That's another key takeaway. So if I were to put in place three kind of important trends, I would say that uncertainty is going to be here to stay, but nevertheless, there will be divergence between Asia and developed markets. And third trend, I would say that is really we are at the peaking. We are very near the peaking of interest rates, especially in the US. And in many parts of Asia, we have already reached the peak. So what does it mean for investments? I think very crucially, I think the first thing is that there will be a lot of divergence. You have to be kind of really looking at your investments from a bottom-up perspective, stock by stock, security selection. But the key implication for me, number one, is to really position in quality government or position in quality global investment grade bonds. I think that's the first implication. Because with the peaking of interest rates, it also means that you're locking in at a very high interest rates right now. You might go a little bit higher from a policy rate point of view, but nevertheless you're locking in at a very high coupon for most markets, and I think that's the first implication, to be positioned for quality global investment grade bonds. And of course, if you do get interest rates falling, maybe sometime 2024. You could get a price appreciation from global investment grade bonds. So I think that's the first action or implication that one could take, because it really looks very attractive right now because of the peaking of interest rates and because inflation is likely to fall from here. The next action you can do is, of course, volatility is going to be very, very high. There will be times where volatility will spike again. Since the highs of March, I think things have subsided. But I think with the debt ceiling in May, June, you might get a bout of volatility back up again. So these things will happen. And along the way, geopolitics is something that's hard to explain or hard to kind of predict, but it will come and kind of affect us from time to time. In terms of volatility, there are various ways. There's option strategies that allows you to sell volatility when it's high, or various kind of alternative assets that could help you kind of navigate through some of these volatile times. But also, I think the next takeaway or trend is that because the developed markets are going to face quite a bit of headwinds, given that their banking system is a bit fragile and weak right now, but we have recovered from the turmoil, it's likely that global equities will be trading in a range-bound manner. Albeit there's going to be quite a bit of volatility. So that is going to be one of the features for global equities. But within global equities, you could perhaps expect an outperformance of Asia vis-a-vis US or even Europe. And in terms of sectors and style, I think quality would be very important. You want to kind of buy stocks that are on the top in class within their sectors. I think that's very important, given that we are going to be in a very uncertain period of time. And the reason why I think Asia is going to be outperforming is that I think China's reopening is gaining traction. This is going to have implications for the rest of Asia, as China's consumption-led recovery would mean that commodity producers would benefit, those commodities that are selling into China, for example. And also, I think the tourism factor for China hasn't fully played out as yet, and it's a multi-year kind of game, a multi-year kind of trend that will manifest itself, not just for 2023, but for 2024, 2025. So this is something that's very interesting and will lift the rest of Asia up. At the same time, of course, China's property market is starting to recover, and that also means that there will be a bigger demand for infrastructure, for materials that go into the building of the property market. So I think that's something that's very positive for this year, which has been sort of ignored in the month of March because of the banking turmoil. And of course, Asian banks, Chinese banks have had a very low correlation to the US and European peers because the business model is very much different. They hold less of these CoCos compared to the Europeans. And also, I think it's managed much more conservatively generally because many of Asian banks have gone through their own crisis 20 or 25 years ago. Also, I think another very important feature is that we are seeing in many developing or emerging markets, whether it's China or India, that credit growth is actually starting to pick up quite strongly. So I think that's going to buttress economic activity for these big economies within, whether it's China, India, or even within parts of Southeast Asia. And I think this is going to help that recovery in 2023. And of course, China's leadership has actually set out a roadmap to broaden the recovery in their growth trajectory. There is a very strong focus on growth stability, jobs creation, domestic demand recovery. There is, of course, a commitment towards supporting private sector and entrepreneurship. And I think this is very positive given what happened a year and a half or 2 years ago, in which there was a lot of uncertainty around Chinese policy makers, especially surrounding the idea of common prosperity, whereby there was kind of a lot of focus on bringing down or making healthcare and education as well as housing affordable. So during a year and a half ago, there was a lot of uncertainty associated with Chinese policy, but as a result of this new leadership revamp, there is a shift back towards private enterprise again. But nevertheless, this is something that the risk premium associated with policy shifts, I think that has declined quite a fair bit. Also, I think importantly, there are a few trends within Asia that we have to watch out for. Of course, China's faster than expected recovery that's led by consumption, and consumers consume in various ways. There's tourism, the consumption of services, especially with the reopening after 3 years. But also, I think, interestingly, I think in India, the macro story remains very strong. And I think India looks to be one of the fastest growing large economy for this year. Manufacturing is doing fairly well as companies in the Apple supply chain is setting up production facilities in the country. And of course, external factors, and of course, all these factors will go very well for Indian corporates in terms of profitability. External factors such as crude oil has sort of stabilized somewhat, and some of the high frequency domestic data such as continue to be quite encouraging, such as credit growth, and of course some of the high frequency data such as GST collection and PMIs continue to be quite robust. So this is a positive for India. But of course, the strength has been, the improvements have been really in terms of service exports, which has risen quite rapidly over the last few years. But clearly, going forward, that sort of pace might slow down somewhat. So I think overall, we think that India's growth could likely slow from 6.8% for fiscal year 23 to about 5.5% fiscal year 24. Still very solid, one of the fastest growing economies, large economies in the world. And I think in terms of inflation and in terms of the rates outlook, we think that the RBI will likely pause from here after 50 basis points increase in the repo rate. We think that they will kind of keep rates on hold at 6.5% from here, really because inflation is likely, in their view, likely to kind of moderate somewhat, and they will put on pause. But if inflation does increase again, they might actually raise rates. But I think our view is that they will keep it as where they are right now for the rest of this year. They will probably cut early next year, especially if it falls much faster than expected. So this is really a sign that the inflation has sort of kind of peaked. And also, very interestingly, inflation dynamics in India is also a bit different from the rest of the world. The rest of the world is facing service inflation, in which services, house prices, etc., are rising, and wages are rising, while goods price inflation is actually fallen for most parts of the world. Well, India, the story is opposite. Goods inflation actually is higher and going up, while service inflation is actually falling. The reason is because there is increasing signs, as I've mentioned earlier, there is increasing signs of domestic activity, particularly those led by the informal economy. So the rural spending has actually increased, buying food and goods, etc. Really because of improvements in many in many parts of the agriculture sector, and that's why we see goods inflation starting to pick up more than service inflation. So that this is a different trend, something to watch out for. But nevertheless, I think that the central bank is quite happy to keep rates where they are. But also bear in mind that rates at 6.5%, your inflation is lower than that, which means you have a kind of a positive real rate, which would slow the economy and also slow inflation down, which is a positive thing in that sense compared to many parts of developed economies whereby their policy rate is still lesser than inflation, so they have to push the interest rates even higher until they can have a positive real rate. So I think that's a fairly kind of a strong or solid position that RBI is at. So I think longer term, there is structural long-term support for Indian equities, but I think near term, we are neutral on Indian equities really because valuations are a bit rich, and how we see from an asset allocation perspective is that India and China is a pair trade. We kind of prefer China right now because of reopening dynamics. But if we do decide to kind of take profit on China, we might actually switch into India.
Yeah. Thank you so much, James, for that elaborate presentation. And we do have lots of questions. So I'll just kind of start with them. So you mentioned about, one of the themes or one of the things to look at is China reopening. And there's this question that would China reopening actually really impact, crude oil prices significantly? And what's your view, or is it too early to read into that?
Yeah, well, I think, make no mistake, China's reopening is actually in some ways inflationary in nature, because as it reopens, it requires energy, more consumption. So it is sort of inflationary, but it reopened early this year. But if you were to kind of go back in time, if they had reopened back in early 2022, back in time 1 year, that if they reopen at the time, I think it will be even more inflationary because at the time you have had, it was before the Russian-Ukraine war, it was before you had all the supply bottlenecks that occurred. Shipping cost was very high. So if China reopened at the time, you get kind of a demand shock. And there was not enough oil because there was a war fight going on, supply disruptions in the energy sector. And of course, supply chains where shipping, logistics, all face bottlenecks. So if China reopened at the time, it will be very, very inflationary. So this time round, I think China's reopening is sort of an opportune time because it offsets that growth weakness from the West. So I think that's positive. The demand that will drop from US, from Europe as a result of this whole banking turmoil can be offset by China's reopening. I think that's positive. So from a demand perspective and on the oil market, I would say that net, China's reopening will increase demand for oil, but it does offset the decline demand from the US and Europe. So I think demand side, I would say that net it will kind of neutral things out. But where I think in the short term, we might see some volatility, especially for oil price, really on the supply side. I mean, OPEC has cut oil production quite significantly recently. And I think on the supply side, that might create quite a bit of kind of a shortage in a way. So near term, we might see oil price hovering around where we are right now, or even a little bit higher due to supply shocks. And of course, with China reopening, but I don't see oil price going, much higher from here. I don't see a 120, 130 kind of situation as a result of China's reopening, or even the supply side shocks. It's likely to stay around this high 80s, 90s level. I think maybe even 95 if we do get some of these supply shocks. But I think as the year progresses, I suspect as demand starts to fall, whether it's the tapering demand of China's reopening or as the West slows down even more, I think oil price should start to stabilize as well. So I think that's, of course, a stable and lower oil price generally is actually positive for India. And I think one of the considerations why RBI paused interest rates is because I think the assumption for oil price is similar to what I've mentioned. And that's why they're kind of confident to kind of pause interest rates right now. But of course, if oil price does escalate very high, and then they might change the playbook. But I think as of now, that should be roughly where oil price should be. Thanks for that question.
Yeah, no, thanks for putting it so beautifully and simply. I'll just move to the next one. So this one is actually, I mean, we did talk about gold, but I'll just take it's a pretty interesting one. So historically, we have seen gold, sensitive to real rates, and we have seen this disconnect, recently. But going forward, do you see that impact on gold prices in terms of real rates actually showing up?
Yeah, that's a great question. Gold's a fascinating one. Again, let me take you back 2022 again. If you tell me that there's going to be a war, a big war, you tell me that there's going to be commodity prices is going to escalate as a result of the war. You tell me that inflation is going to hit 40-year high. Then most people will think that gold price is going to double or triple or whatever. Everyone will rush to gold, right? Because of wars, hyperinflation. But what happened to gold for 2022 or throughout? It was actually flat. It didn't move anywhere. Why is that so? I think that's quite fascinating. And it's really what you mentioned. It's actually interest rates. Because of interest rates, the Fed had to increase interest rates very, very, very fast. And that's why gold price did not go anywhere. You have had dollar strength as a result of rising interest rates. And also, as gold, it doesn't give you any interest at all. Dollar makes more sense for 2022. That everyone rushed towards the dollar that gives you higher and higher interest rates. So I would say that at this point of time, I'm not so. I don't think gold is going to get a bull market because it needs a lot to happen. You need probably interest rates to fall dramatically. You need the war to escalate even more, sort of situation, which I don't think is likely. So I don't think gold price could really run up significantly from here, nor do I think gold price is going to collapse. So which is given that interest rates are going to be on a pause, very likely from here. So I think a range-bound view for gold is quite likely going forward. Given that in 2022 gold price was moved on the straight line almost. Thanks for the question.
So much. So this one, it's connected to basically the digitization story, which you kind of also mentioned in one of the themes. So you did mention that how you would prefer, Asia or, specifically certain countries from Asia as compared to developed markets. But do you think this entire digitization story or industrial advancement, artificial intelligence, is it going to be like a complete game changer? Like some time back, we had software story where you had the developments happening in Silicon Valley and the Asians were basically, it was more like a supply of cheap labor. But now do you see these tech giants actually emerging from Asia rather than, developed nations?
Yeah, well, I think great question. And I think this question can take on multiple directions really, because there's just so much to really unpack. I think one of the kind of the benefits that came out from the pandemic was that it made the world much more digital. And I think one of the winners, I would say, would be in large emerging markets like India, a lot of Southeast Asian countries benefit from this because it forced everyone to go digital to get your daily food whatsoever. So I think that's a very positive sign, and it increased a lot of efficiencies in many ways. Particularly, I think for India, because it sort of transformed, or it kind of made a lot of the informal part of the economy formal once everything is on digital. And also it increases a lot of productivity in how things are being done, whether it's through tax collection, whether it's through small businesses trying to get credit, for example. And now because of this, they are able to access credit or access banking facilities because of having digital records. And I think this really sets the foundation for many, many more things to come. And I think clearly, I think India is going to benefit a lot from this going forward. So I think the digital economy is here to stay. And I think it's clear that the winners from this digital economy are really the super apps that are very much localized. You have yours in India, South Asia have their own version. And you do see even the big, the US kind of apps doesn't really work well in the local context, right? Whether it's Uber, Airbnb, well, they are around in some parts of the markets, but they are not the leaders. The local ones are the ones that I think will win from this, and they will continue to consolidate. They'll continue to kind of become stronger in their position. So I think they're here to stay, I believe. So that's on digital economy. In terms of a related part, you mentioned about AI, and of course, we have now with ChatGPT. What's the implication? It's, to me, I think there are many, even for ChatGPT, there are many dimensions of this argument. But I want to take the nearest, something that is nearer to, well, you can always argue, will someone lose their job or that sort of thing. But I think that argument is further out. Where I think the nearer implication would be that right now what we are witnessing is that every big tech, whether you're the US big tech or China big tech, everyone is increasing their investments towards AI and towards generative AI. Why is that so? Because the most important implication is how we search our information. And for the last 15 years or so, Google has been the gateway, the door to how we search. And the way Google searches, there is also an algorithm that kind of force us to do certain things. So and that's how Google made their profits from it. So the one who holds the gate towards the internet was Google, and they were very profitable because they can drive traffic as a result of how they determine the priority of your search. With ChatGPT, it could become the gateway again. So whoever owns this new gateway would actually be very, very, very powerful. It could wrestle away a Google search in that sense. So it can be a Microsoft, it can be a Chinese tech. And I think that's the nearer term implication of who will win the gate towards the internet. Because if you can search better, not just your usual search, we all use Google, but sometimes it doesn't give you the right answer, But if that AI could give you a better search function, I think that would be a game changer, and that would be the near-term implication for who will be the near-term winners in the big tech space. Of course, there will be long-term arguments of jobs and stuff, but I think maybe let's leave it for another time.
Yeah, thank you so much. We already have the next question. So there has been a lot of talk about, India's inclusion on, the JP Morgan Global Bond Index. So do you really see that making a material difference, or do you see that really happening pretty soon? What's your view on that?
Yeah, well, I think that's something that a lot of market participants are watching out for. And I think as India's economy it has already become very, very prominent. And of course, your financial markets, as a result of the economy, becomes more developed, broader, and wider. It has to be represented in international indices. sooner or later. So I think that's clearly a trend. It can be any of the international indices that you have to include India much more prominently. So I think, well, definitely, I think whether it's a this year story or next year, I think the trend is for a bigger representation of India in financial markets. I think that definitely that's going to be happening down the road.
Okay, thank you so much. One more question related to India. So while India is really, or Indian equities are really preferred, we don't really see that kind of rich valuations for, PSU stocks. So since, we have an international investor here today, just to kind of understand, are Indian PSU stocks not really looked in a very good light? Is there a constant a concern about governance, etc.? Because in spite of being market leaders, in spite of having very cheap valuations, we don't really see that kind of interest in PSU sector for that matter. So if you could just share the perception that's there in the investment committee.
Yeah, I know. That's a great one because we do see a difference of view. Typically, most investors, domestic investors in India are very, very bullish on India, while international investors not necessarily. So you get the difference of view. And I would say that the most international investors believe on the long-term trajectory of India. That's for sure. They believe in the structural story, and all external investors have to have a long-term strategic holding in India for sure. But over the short term, national investors have to kind of always weigh where are the opportunities from time to time, because we are always gauge or benchmark. So that's the issue. As a long-term investor, you don't have that stress. But for most international managers, they have to, on a month-on-month basis, they have to outperform the market in that sense. So I think in the near term, generally, I think the flows, of course, in this case, there were corporate governance issue earlier part of this year. It will go through, I would say, in most Asian developing markets, there's always corporate governance issue. That's for sure. But it will kind of, I believe, set in place a sort of a reform towards a better corporate governance standards, I believe. And I think that will be positive for India equities long term. And I think that's something good, I think, believe will come out of that. But I think in the near term, most international investors at this stage are still positioning a little bit biased towards China versus India, because if you just compare the valuation difference, it's quite great. So they rather take that bet right now. But I would say that come a time, if we do get a significant rally in Chinese equities, I'm quite certain that a lot of international investors would rebalance back into India. So this is always a pair trade, China and India. I think most international investors look at it, and usually very seldom do they go bullish on both. They usually just kind of take one at a time. Given that the allocation of capital is limited, right? You can't buy everything at one time. So I think at this stage, I think the preference for some of the international investors is to prefer China over India, but there will come a time where we can take profit on China and move into India. Thanks for the question.
Thank you. So I'll just take one last question. There have been lots, but in the interest of time, so there has been a lot of noise about this. How, like for example, a lot of like the BRICS region, for that matter, or different countries entering into collaboration to have exchange or trades which is not dollar denominated. So do you really see this it's not really a major event, or do you really see this challenging dollar hegemony going ahead?
Yeah, well, I think that's a big one. I would say in some way this trend, it's sort of exacerbated by the Russian-Ukraine war in some ways. Because of that war, a lot of the oil supplies that could not be, or Russian oil that could not be sold to Europe, was actually bought by China and India. And once that deal goes through, you need to deal in dollars, right? You could deal in your own currency. So How I will answer this de-dollarization story, it's on perhaps three dimensions and the functions of money. Money has three functions essentially. First, a medium of exchange. So any currency is used as a medium of exchange. Second, a store value. And third, unit of account. Let me go through each of these dimensions and I'll explain whether the dollar would still be around. First, in terms of medium of exchange. First and foremost, if you notice trade flows, most emerging markets' top trading partner is actually China. Whether it's Middle East, is China. China's been buying the oil, natural gas. China's top trading partner. Latin America, likewise, top trading partner in Latin America is also China, buying up food produce, etc. ASEAN as well, China's top trading partner. So naturally, you will see increased prominence of the RMB in terms of trade because of the rise of China's trade with the rest of the world, and of course with its growth. And of course with what you've mentioned with this BRIC kind of grouping and in terms of transactions of oil, for example, there will be a greater use of non-dollar currencies. In terms of the next issue of how money is used is stored value. And investors and clearly, I think if you look at the reserve currencies by central banks, 60% of central bank hold currencies exposure is actually still the dollar. 60%. Around 25% is euro. Central banks will hold on average about 20-25% euro, 60% dollars, and only about 3% in RMB. So if you look at the store of value in terms of the central bank holding 60% versus 3%, RMB is still a long way to kind of challenge the dollar from a store of value perspective. And so that's a very important thing. And why is this so? It's really because of the liquidity and of the dollar market, right? The liquidity and the financial instruments associated with it, whether it's the US treasuries, whether it's the financial markets, whether it's liquidity. I think US dollar is still it's still a very big component of the financial market architecture. So RMB is slowly internationalizing, but I think it's still, I feel 5 to 10 years away from being much more prominent to even be able to challenge the dollar from a financial markets point of view. And the third aspect, unit of account, I would kind of categorize it as somewhat the standards of why we had the dollar in the first place. It's really after the war, right? After World War II, in which you had all these international organizations like the IMF, World Bank, that helped the redevelopment of the world through giving out dollar loans, setting out standards, accounting standards. And also with that, growth of the American economy, helping to rebuild Europe and rest of Asia, you did see the growth of US multinational companies as well, and that led to kind of the where the US dollar is. Will that change overnight? I think that's slowly being eroded. That whole Washington consensus slowly being eroded. I mean, China had their own organization, the AIIB, for example. China has its one road, one belt. And also, China also has its own multinational companies that are alongside this one road, one belt. So that challenge, I would say, is slowly eroding the US dollar, but I don't think it's going to happen overnight as well. So I think to kind of summarize, yes, at the margin, you do see some aspects of the dollar losing its prominence, but I think for the dollar to lose its dominance, it takes a lot, and probably it's not going to happen in the next 5, perhaps even next 10 years, for example, because the lead, especially from a financial markets perspective, is quite great. And also from that, the kind of institutions and standards that is built around the US dollar. I think for that to change, it takes a lot as well. So my argument is that dollar will still be here. It's losing a little bit of grounds on trade, etc. But nevertheless, it's still going to be very important. And of course, you can also throw in cryptocurrency into the whole mix, right? That will complicate the whole things. That's another contender, right?
Yes, thank you so much, James, for answering that question so elaborately. I guess I have one last question, but we wouldn't have enough time to answer that. So with this last question, we'll be closing. So thank you everyone for joining in for this session. And thanks so much, James, for sharing your elaborate insights and really putting things so lucidly and clearly. Thank you, everyone. Good day.
Thank you. Thank you all.